More than 1 million Canadian mortgages are set to renew this year. That is roughly 1/5 of the overall mortgages held in the country. And that number is set to increase over the next couple of years as a result of the most common mortgage term in Canada being 5 years. And 5 years ago was the kickoff to an exuberant marketplace that was fueled by ultra low interest rates. What that means is that here in Canada, many homeowners are about to have their mortgage rates increase from as low as 1.49% that we saw at the height of the pandemic to now somewhere in the 4.5% range. And that means that if you took out a $500,000 mortgage at those rock bottom rates, if you are set to renew this year, your payment might be going from as little as $1,723 per month to maybe as much as $2,533, or an increase of over $800 per month, not including property taxes, utilities, or strata fees. And my clients are actually in the exact same boat, even maybe more so. Recently, I pulled my entire database and found that of those who responded, exactly 1/3 told me that this was the year that their mortgage was up and it was time to renew. But renewing your mortgage is a tricky game. Commit too soon, and you might miss out on further rate cuts that could be coming around the corner, costing you a ton of money. Wait too long, and you could be stuck with whatever rate your current lender offers you, costing you a ton of money, or fail to negotiate correctly with your current lender because you didn't watch the rest of this video, which will, of course, cost you a lot of money. So rather than getting screwed over by the bank or big mortgage lender, here is my list of things that you should do if your mortgage is up for renewal this year. Starting off with step number 1, keep your eye out for your new mortgage term renewal offer from your current lender. Depending on the institution, somewhere between 90 and 120 days before your mortgage renewal is set to occur, your lender is going to send you a notice of renewal. Contained within that letter will be an offer rate that you can renew for today. Now, I too am among the 20% of mortgage holders that are going to renew this year, and I have just lived this experience. So I will use the real numbers from my bank so you can see the cost savings that may be available to you in your situation. So let's get back to the letter. The letter that arrives in the mail about, I don't know, say halfway down the page, there are all sorts of terms from 1 to 10 years for both fixed and variable rate products. And for the sake of this video, we're going to use the most common mortgage type, which is a 5-year fixed rate offer, which was, for me, as low as 4.59%. Now, believe it or not, this was actually a pleasant surprise for me because I have been nervously monitoring my bank's website for the last 5 months or so. And the best offer I saw there was 5.09%, or a monthly difference to me of $26 per every $100,000 borrowed monthly, again over a 5-year period. Meaning that if you didn't wait for this letter and you just took the rate that was online and your mortgage was $500,000, over the next 5 years, the difference in payment would have been an extra $7,800. But I didn't stop there. I moved on to step number 2. I called the bank, and after authenticating myself and a little bit of small talk with the fella on the other end of the phone, within about 10 minutes or so, that 4.59% interest rate dropped again to now only 4.44%. Again, when you do the math, let's say, for instance, I had a $500,000 balance on my mortgage. That 10-minute phone call resulted in me saving another $2,400, meaning that just step 1 and 2 in this video has already got the potential over the next 5 years to save you $10,200. You're welcome. Now, of course, if your particular mortgage is more or less, then your savings will vary. But if you're still not happy with the lowest rate that your bank offers you, you need to proceed to step number 3, which is to shop around. Sometimes your bank wants to keep your business, but other times, other banks want your business even more. For some reason, new business is more desirable to big corporations than keeping their existing clients happy. As a result, if you shop around to other banks and let them know that you have a certain rate from your current bank, there's a very good chance that they will undercut that rate that you are being offered, just strictly to steal your business away from that other institution. But you have to be very careful when shopping around. The one thing you probably do not want to do is shop those rates all by yourself. This is because every mortgage application that you do comes with a credit check. Get your credit dinged 2 or 3 different times by a few different banks in the same week or month, and you are going to be viewed as a credit seeker, and the banks will know. And they'll know because they can see it, and it will damage your credit score. So rather than shop around at all the different banks and do all the work on your own, proceed to step number 4. Speak with an independent mortgage broker. An independent broker can check your credit only once and then shop your file around to all sorts of different banks to see who will offer you the best rate and the best terms, which are not always the same thing. Brokers also have access to something called non-bank lenders. These are companies that don't have branches, checking accounts, or financial advisors trying to sell you RRSPs. They are institutions that only lend mortgages, and often, because they don't have massive overheads, they can offer better mortgage products because, well, that's all they do. And on a very quick side note, if you are looking for an independent mortgage broker, my recommendation is Citywide Mortgage Services, and I will link their application to a mortgage just down below this video so you could get started right now. 5th, it's time to explore variable versus fixed rate products. Now, I personally am a fixed rate guy. I like the security of knowing that my payment is my payment and that it will not go up. But if you are okay with some risk, you could take a variable rate. This means that depending on the institution that you borrow from, if rates change, so will your mortgage. With a variable rate mortgage, your payments could go down, or your amortization, otherwise known as the life of the loan, could be shortened. But if rates go up, well, this is where the risk comes into play. And you had better get educated on what happens when things don't go your way. Number 6, consider consolidating other debts into your mortgage. Other debts like student loans, car payments, and credit cards can be at a much higher interest rate than what you're being offered on your real estate. So if you can qualify, it may be best to roll those bad debts into a lower rate. But a caution, this will make your mortgage payment rise from where it currently would otherwise be. But when looking at your overall debt load, it will likely reduce your monthly bills, and that could be a good thing for your cash flow. And 7th, consider playing with your amortization or even putting down a lump sum. If these new rates are going to make your bills harder for you to pay, there is the possibility that you might be able to extend back out to 25 or 30 years in order to bring your payments down in line with something more manageable. But this can also work the other way as well. If you can handle a little bigger payments and you want to pay off your home faster, this also works if you have extra money saved up. Before you renew, maybe you can put down a lump sum payment to reduce the amount owing at the renewal time, and then that will result in a lower payment in the future. Or again, you could use that to pay off the loan faster. Oh, and the last thing I will leave you with is there is one term in the fine print of almost every single mortgage that could cost you to lose your home, even if you never miss a mortgage payment. And to find out what that specific term is, you're going to have to watch this video right now. Specifically, if you have more than one debt at any single institution, you need to watch this video right now.